Welcome back to the channel. Today we are talking about First Majestic Silver, ticker AG, for the second quarter, fiscal 2026. Here's the most important piece to understand before touching this name. First Majestic Silver's entire earnings story this quarter came from silver prices, not from volume. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. Okay, let's get into it. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk and your results may vary. So, on the headline, revenue came in almost 30% below the estimate. That's a big miss on the tile. But here's the thing you have to understand. Year over year, revenue was actually up 57% to $415.5 million. The analyst number was set way above what the company delivered, and about $40 million in mark-to-market adjustments on open concentrate sales dinged the reported figure as prices softened into quarter end. And on EPS, they missed by about 22% versus the estimate. But look under the hood. Adjusted EPS came in at 21 cents, up from 4 cents a year ago. That's roughly a 455% jump in true operational earnings power once you strip out a one-time $10 million Mexican tax charge and the mark-to-market noise. Now the letter grade is what it is. Measured purely against the analyst estimates on the tile, this earns an F on the beat. Both revenue and EPS missed by material margins, and the rulebook grades the headline surprise, not the clean number. And on consistency, this also lands at an F. When you miss both lines by this much, the track record of clean beats just isn't there, no matter how strong the underlying business looks. Let's talk about the positives from the report. The top line jumped 57% year over year to $415.5 million. And here's the key. Production only grew about 3%. Almost all of this came from a 90% jump in the realized silver price to about $64 an ounce. This is a pure price realization story. Free cash flow hit $194.5 million, up 150% year over year, and that's after paying nearly $47 million in cash taxes. This business is throwing off serious cash right now. Their all-in sustaining cost margin, basically what they clear per ounce after all costs, went from about $14 an ounce a year ago to over $40 an ounce this quarter. That's the operating leverage the bull case has been waiting for. The balance sheet is the standout story. Treasury hit a record $1.25 billion, up 34% since year end, and they used that cash flow to hike the dividend 217% and buy back over 1.2 million shares. Mine operating earnings jumped 353% to $223.5 million. That's what real operating leverage on higher silver prices looks like when it flows all the way through. So on profitability, I'm giving this an A. Margins expanded dramatically. Mine operating earnings tripled, and the cash conversion is genuinely impressive. This is as clean a margin story as you'll see in the silver space this quarter. Now let's talk about the negatives from the report. Cash costs per silver equivalent ounce were up 20% year over year, and all-in sustaining costs were up 22%. The Mexican peso got about 11% stronger against the dollar, and royalties tied to metal prices pushed costs higher. About $40 million in mark-to-market adjustments on open concentrate sales hit reported revenue as commodity prices softened into quarter end. That shows you how fast realized prices can compress if silver retraces even a little. There was a one-time $10 million tax charge tied to a settled historic Mexican tax dispute at their Plata subsidiary. It's non-recurring, but it did drag on reported net earnings. They had a rockfall on the main ramp at Los Gatos, and some labor disruptions at San Dimas. Both are resolved now, but they did push per ounce cash costs higher during the quarter. And the silver equivalent conversion ratio shifted from 98 to 1 down to 75 to 1. On the old assumptions, cash costs would have looked about 13% lower. So some of that cost inflation is methodology, not just real cost creep. On guidance, I'm at a C. Management referenced updated 2026 numbers to be discussed on the call, but they didn't put specific revised figures in the release. That's reduced visibility. Not a raise, not a cut, so it lands right in the middle. And on red flags, I'm at a C+. The mark-to-market sensitivity on open concentrate sales is the one thing I can't dismiss. A $40 million drag in one quarter tells you exactly how quickly the margin cushion narrows if silver drops back into the 40s. Look, this is a print with two totally different faces. On the tile, they missed both lines by material amounts. But underneath, adjusted earnings power jumped roughly 455%, free cash flow was massive, and the balance sheet turned into a fortress. The entire thesis on First Majestic Silver right now is a leveraged bet on silver price stability or appreciation, and this quarter reinforces that view rather than resets it. Putting it all together, I'm giving this print a C-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. For me, the setup here looks reasonable if I'm a silver bull. The record $1.25 billion treasury and that new formal dividend policy tied to 2% of revenue give me real confidence in the story. So instead of just buying shares outright, I like selling cash secured puts, while implied volatility is still puffed up from the print. That elevated premium is the edge I want to capture. I'd pick strikes below the current price, levels where I'd only get assigned on a meaningful silver pullback. Even then, I'm ending up owning a cash-rich miner with plenty of margin cushion. So the way I'm playing it, I sell puts on the volatility pop. The all-in sustaining cost of 25.68 versus a realized silver price of 63.98 gives me a huge margin cushion. That lets me sell puts a little closer to the current price than I could before this print. But I'm not getting greedy. That $40 million mark-to-market drag on concentrate sales is a reminder of how quickly realized prices can compress on me if silver rolls over. So my strike floor sits meaningfully out of the money, at a level I genuinely want to own, even if silver pulls back into the $45 to $50 zone. Anything closer to spot only makes sense if I'm actively trying to get assigned into the dividend hike. Bottom line, I stick to strike floors I truly want to own. For me, this print is a hold and collect story. That 217% year-over-year dividend increase tells me the company is finally rewarding shareholders in a real way. The record treasury combined with the new formalized dividend policy directly validates owning the shares rather than trading around them. I'd rather sit in the position and let the payouts build. The only reason I'd trim is if silver goes parabolic well above these realized price ranges. Nothing in the release shows operational deterioration, so there's no fundamental reason for me to lighten up here. So my move is simple. I hold and let the dividend compound. That 90% jump in realized silver price and the record treasury make me not want to cap my upside with tight covered calls. This business is monetizing the silver price beta really efficiently right now. So I want to keep participating in that upside. Writing calls too close to the current price gives away the exact leverage I want to hold on to. If my existing strikes get threatened, I roll them up and out. If I do get assigned, I only let the shares go if I plan to re-enter by selling cash-secured puts on the next volatility spike. So my plan is I roll up and out and keep my upside. This print directly validates why I'm holding leaps in the first place. Production is stable, and the Treasury compounded $315 million in just 6 months. On top of that, the new formal dividend policy returns capital as a function of the same silver price my leaps is leveraged to. Everything about the setup lines up with my original thesis. The only reason I'd roll up and out is if silver breaks meaningfully higher and I want to lock in delta on a longer dated contract. Otherwise, I just sit tight. So my move is I hold the leaps, thesis intact. The release completely validates my original bull case. Mine operating earnings grew 353%. Cash is at a record, and the dividend is now formalized. With numbers like that, I'm not cutting my position. If anything, I'm looking to average down and lower my cost basis on any weakness. My ad zone is on silver-driven pullbacks, particularly if the stock retraces alongside spot silver into the $45 to $55 zone. Even at those prices, the all-in sustaining cost margin still supports meaningful free cash flow. So the way I'm playing it, I average down on silver-driven weakness. Bottom line, this print earns a C- from me. The headline misses look ugly on the surface, but the underlying operating leverage and the record cash position tell you exactly what this business becomes at elevated silver prices. Thanks for watching, and I'll see you on the next one.